Now, as we talked about in the last segment, we're going to pivot to China for a moment. And I think it's important to look at Chinese debt, because when you look at the debt side, a lot of individuals like to say, oh, it's all internal. It's sold back to the China. It's fine. They can manage it. But when you look at the external debt to China as a percentage of gross national income, and this is as of 2020, so it's actually gotten worse since then, you can see where they have their exposure. And the problem is, you can write it off. You can say that, oh, well, China did it on purpose because they want to, invade countries without saying they're invading countries. But there's still a cost associated with it. And that cost has to be written down because some bank wrote that debt. And that debt has to be forgiven, thrown out, bad debt expense. But when you do it multiple times across multiple areas, it compounds on itself. And then it creates the issue of, well, what is inflation going to look like? How secure is this bank? Should I worry about my yuan and my renminbi that's sitting in the bank right now, or is it going to be worthless? So then when you look at Chinese finance directed towards Africa, loan commitments, foreign direct investment, you had a huge increase. And then through Chinese loans to Africa, you had about 159 billion US dollars. So when you look at the backdrop and the expansion, the question then becomes, what are the potential losses? Because it's only gotten bigger from 2020, and it only really accelerated towards the end under what used to be the One Belt, One Road to the Belt and Road Initiative. So there's still pockets of issues when you consider where their exposure is, how that exposure looks, and then how do you factor that into what should one of their banks, what is their risk profile, what is their leverage ratio? Because if they're not collecting interest to cover their principal, well, then the interest and the principal are worthless. And the assets, you could say you can take ownership of the asset, but what does ownership look like? Is it below, when you consider the multiplier effect, is it below 1 where the bank took a bath and anybody who invested took a bath in it? And how many times can you do that before you have a real issue in terms of sustainability? So then when you look at completed debt restructurings by creditors, China, Paris Club, private, you're looking at the amount of restructuring that has continued to happen. So when you look at Sri Lanka, Zimbabwe, Venezuela, Seychelles, Cuba, Ethiopia, all of the restructurings have been happening by China. So what happens when you look at the defaults? Because if you were looking to come in, take ownership, and just forget it because this was your way of accumulating land, you wouldn't be looking to restructure because you would just say, now I own this, it's mine. But you still need to pay people that gave you money. And that's where the disconnect is in terms of what are the risk profiles on external Chinese debt and internal Chinese debt. And they're very much linked when you're looking at how they invested. The risky business side, so the restructurings of Chinese loans to other countries have become more common as China's lending overseas has expanded. Sovereign debt restructuring by lender type, Chinese creditors, private creditors. So when you look at how much the Chinese have been investing in these areas and now having to go and restructure, there's more and more risk. And it's happening at a time when their debt to GDP is at the highest it's ever been, while the currency is coming under pressure, while exports are slowing, while their real estate sector is imploding at a very fast clip, and the consumer doesn't want to spend, which is keeping that pressure there when you consider the Chinese investment share of the economy is among the highest in the world because China's economy is heavily reliant on investment. So that's where you've created this churn. So if you look at the risk profile and all of a sudden things start to slow, well, then what? China's blistering pace of domestic investment has built the world's largest network of high-speed rails, most of the world's 10 longest bridges, the world's busiest ports, but also by some estimates, enough empty buildings to house the entire population of France. That investment consumption imbalance is deeper than it was in Japan in the 1980s, before the famous lost decade, and with China accumulating total debt worth almost 3 times its GDP. So when you consider the risk, well, what is the risk? Then when you consider Chinese household consumption, if there is no investment, consumption will be like a tree without roots. Why? China in recent months has already cut interest rates, approved infrastructure projects, and given banks new quotas to fund them, increasing debt. To pop up the distressed property sector, many cities have reduced down payments and eased mortgage rates. But when you look at actual household spending, it's one of the lowest out of the OECD average, US, EU, Germany. You're looking at something where it's even below the global average. The local consumer doesn't consume. This is a cultural thing, but it's also just, what is the comfort? Where are my lockdowns? What do my lockdowns look like? Am I going to have a job? Employment has been a struggle since well before pre-COVID, all of which they've tried to, or they addressed in this most recent Congress, and I'm going to talk about it in a minute. Then when you look at unleashing pent-up savings, the view is that savings are there, so you're going to see savings come back in. But what is the value of those savings? Are they going against the down payments they put on something that's never going to be delivered? Did they give builders money to go build, and now that money is forever gone? Did they invest in some of these bonds into other nations to build out infrastructure? So when you look at the household deposits, it may look good, but what is it against? And when you look at the liabilities, and what is the safety of the bank? Is the bank going to have a currency problem? Consumers have cut back on lockdown uncertainty. When you look at retail sales, it's just gone flat. And what we expect is another roll down of pressure. With China's growing debt much faster than its economy, in the decade to 2020, China consumed almost 25 times more cement than the U.S. By 2021, state-owned China State Railway Group had 5.92 trillion yuan in liabilities, more than the GDP of Saudi Arabia. So who owns that? How are you financing that? Or do you really have revenue to support that in general? In the property market, which now accounts for a quarter of China's economic activity, businesses took more risks and banks offered mortgages before flats were built, leading to the oversupply. Many developers like China's Evergrande paid suppliers in commercial paper instead of cash, so when it defaulted, its supply chain collapsed. Again, more pressure through the system. One business owner spoke on with Reuters, because these quotes are coming from Reuters, that spoke on the condition that his firm at its peak made 150 million yuan a year supplying promotional materials to Evergrande, and he now lives in a dormitory and earns 3,000 yuan a month working in a screw factory. And all of this supported this massive increase in just debt. So the question is, as that debt has risen to such levels of 352 times GDP, well, who's going to be on the hook? You know, when these write-downs start and people take haircuts, who's going to take the haircut? And that's where you're not a reserve currency. The U.S. has abused the power, but is benefiting from the fact that they are a reserve currency, leading to additional problems. China pumps credit into its economy whenever exports slow. But what happens when there's a more permanent slowdown? So with indebted local governments starved of cash as plummeting land sales hit revenue, because remember, land sales were a big way that local governments got revenue, heavy infrastructure spending seems an unlikely fix. China is widely expected to miss this year's 5.5% target, obviously. Oxford Economics expects average annual GDP growth this decade to halve from the 1999 to 2019 average to 4.5% and slow to 3%, which we still think is a bit high given where things are, especially when you look at exports. So when you look at exports slowing, well, are they going to pick back up? What is reshoring and onshore? What does onshoring and nearshoring do to their export base? You know, as exports come down, where's consumption? Or is the consumer going to pick its head up in general? And the short answer, in our opinion, is no. So the number of mentions in the party Congress. So when you think about economy, markets, and reform, you see it being mentioned less, while security, self-sufficiency, party, and politics is rising because they're letting people know things are going to get a bit worse, but you have to worry about your security. You have to focus on self-sufficiency, be a good comrade, make sure you're doing things for the party and for and again, the politics behind it, but the party stands at its core. And that's going to be difficult to swallow when people can't eat, when people don't have food, when people don't have a job. And it gets made worse in terms of confirmation of new shutdowns. Qingpu District shut down all cultural and entertainment venues. October 13th, Songjing District closed all indoor entertainment venues. Yangpu District also shuttered indoor cultural and pieces. Residential compounds have been subject to 2 to 7 day lockdowns. Our lead COVID analyst stationed in Shanghai began another 7-day lockdown in the western suburbs, and our lead COVID analyst is it's Trivium, speaking from Trivium's perspective, that suggests a broader than usual designation of medium risk areas. So again, you're seeing that the residential compound had no reported infections or close contacts, but yet they still locked it down. COVID lockdowns are horrible for businesses, but during Party Congress week, local officials are even more lockdown inclined than usual. Nobody wants to be embarrassed again during the Congress. So you've seen an increase in censorship. You've seen an increase in lockdowns, all while trying to focus on not losing face while this important Congress is happening. Now, some of the feedback from what we've seen so far. So when we look at some of the different pieces, only 3 of the current 7 PBSC members will stay. Top party theorist Wang Yung and anti-corruption czar Zhao Li are likely to join Mr. Xi as the only members of the current standing committee to get another term. Everyone else will be replaced. So when you look at some of the different pieces, if these reports reflect the final lineup, Xi will have achieved an even more thorough shakeup of the party's top leadership than many expected. How Xi stacks the new PBSC will indicate his power and policy trajectory for the next 5 years. The new leaders will walk out on the red carpet on Sunday morning. So right now, when you pivot to Taiwan, they essentially haven't changed their stance. Resolving the Taiwan question, realizing China's complete reunification is a historic mission. But while highlighting Beijing's preference for peace, the report also warned, we will never promise to renounce the use of force, and we reserve the option of taking all necessary measures. Very similar to what has been said before. So when you look at many challenges facing China, haven't changed since Xi came to power in 2012. And in his own words, imbalances and inequities in development remain a prominent problem. China's capacity for scientific and technology innovation is not yet strong enough. Many major issues need to be resolved to guard against financial risk and ensure that food, energy, and industrial supply chains are secure. Food is there again, financial risk issue. Quite a few challenges exist on the ideological domain, again, trying to drive home the party and centralizing on the party itself. Wide gaps in development and income distribution between urban and rural. Rural is a key focus for them to drive and repair and replace a lot of the food, which is going to be a big piece, as well as where are they on the common prosperity problem. Environmental protection, some party members and officials lack the capacity to grapple with tough challenges. Again, showing that there could be a potential purge if you fall under someone who can't grapple tough challenges. Eradicating breeding grounds for corruption, connected obviously. But one issue in particular is increasingly at the forefront of Xi's comments. External attempts to suppress and contain China may escalate at any time. We must therefore be more mindful of potential dangers and be prepared to deal with worst case scenarios, obviously referring to the U.S. Xi gave his full endorsement of the policy's success to date. In responding to sudden outbreaks of COVID, we put the people in their lives above all else and tenaciously pursued a dynamic clearing policy. Again, supporting zero COVID. We have protected the people's health and safety to the greatest extent possible and made tremendously encouraging achievements in both epidemic response and socioeconomic development. Again, that is here to stay. There was a view that you could get essentially a bit of a reduction in COVID policy or zero COVID policy, and here we clearly aren't. Common prosperity. Xi's signature campaign is a key topic. The report Xi gave at the opening session: common prosperity is an essential requirement of socialism with Chinese characteristics and a long-term historical process. The implications of income redistribution have caused anxiety in China's private sector among tech companies and obviously their investors. And there's still nothing concrete on what it's going to do. But he reiterated calls in terms of increase the income of low earners, expand the middle class. But something that was important: we will regulate the mechanism for wealth accumulation and regulate excessive income. This is the first time we've heard Xi talk about a mechanism to regulate wealth accumulation. It's unclear what this will mean in practice, but it could have huge implications for the rich or those looking to become rich, obviously taxes. Expect policymakers to provide more clarity as we progress after the Congress. With the economy still in dire straits, the short-term priority is going to be a bit different, but Xi made it clear in this report that high-quality development remains the top priority, which suggests Beijing has no appetite for pushing the CP agenda at the expense of economic growth. So there's going to be a matter of how do you push growth with common prosperity, which is going to be very difficult as we go forward. And again, because this redistribution has brought down many a communist country before. So China's CPI, you expected to be at 2.9, came in at 2.8, but still going higher. China core CPI slowed down again. But the big focus is on food security. So as Xi put it in the party's report on Sunday, he wants to ensure that Chinese people's rice bowl remains firmly in their hands, owed back to, again, the rise of the CCP and Mao. Back in 2017, food security was almost an afterthought, which is a single mention. Over the past 5 years, trade friction, with agriculture partners, the supply chain issues have gotten much and a bigger problem. And now this is one of the key foundations of the Communist Congress. Xi included a long list of familiar food security solutions: maintaining a red line minimum of 1.8 billion farmland, investing in farmland to high grading irrigation infrastructure, revitalizing the rural side. Xi also proposed to rethink China's food security, establish a broad concept of food, and build a diversified food supply system. Virtually all these prescribed details in the report are new, but none of these agendas are observers of China's agriculture policy. So again, all still very much happening. PPI slowing, net positive for that direction, but also showing the pressure on the economic front. With China's steel prices are falling due to the shrinking construction, we see that accelerating, which should technically put some of the steel back into the market. So this is going to be an interesting to watch to see how much of this steel finds its way into the market. Then when we look at developers have been starting but not completing homes, again, a big issue in terms of the drain on capital and what does that asset base look like with inventory started minus completed, started minus sold. You see that there's a massive inventory, and who is going to be on the hook for that? What is the value of it? And this is why we talk so much about what is the security side, what is backing all of these assets, which again were built out on spec, and now there's somebody is holding the expense. And with the government and the PBOC already on the hook for 352 times GDP debt side, who backstops this? So then when you look at India trade balance, you saw a nice little bounce, but again, still very much in decline, with India wholesale price index expected to be 11.3%, actual 10.7%. So we actually think India will outperform China, but there's still we think India is going to start to slow down from this point, as you can see in some of these movements, as we've been discussing, but that is for a different day. We wanted to focus more on China today. We hope this was helpful. Thank you again for watching. We won't have our normal shows next week. We won't be doing the EIA or Econ show. I will have the FSC show. I'll try to cover some of that on Friday. marry some of that into it, and then we'll get back to it. I am traveling for business, so but I will have access to Twitter, my email, and trying to check the comment sections. So again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.